Thank you for checking out Fieldman, Rolapp Associates Municipal Market Update for the week of December 12th, 2022. It's our 42nd posting. My name is Adam Bauer, and I serve as CEO and President of Fieldman, Rolapp Associates. Fieldman, Rolapp Associates is a municipal advisor to government. The Municipal Market Update is a monthly posting that we do to give our clients and other market participants an update on how the municipal market has changed since the previous month, while also trying to give some perspective with how that fits in with recent history. Our first focus this presentation is on the FOMC meeting later this week on December 13th and 14th. In 2021, the focus was all about COVID cases and the federal response to that, and that really drove down interest rates throughout the year. And that's really kind of the main focus of things. 2022, the focus has been inflation and the FOMC's reaction to that. And you saw a pretty steep, if you go back to 2005, a pretty steady increase in rates then. Then you start that 2016-17 timeframe, and you see some good increases there as well. But neither of those cases have been as dramatic as the increases that we're seeing in 2022. So beginning in March, we had a 25 basis point increase. And then you see, several pretty large increases there of 75 basis points. I think there was a 50 and then several 75 after that. So pretty big increases in the overnight rate. Based on some comments made by the Fed chair last month, I think many market participants think that we have a 50 basis point increase in store this week. So as we transition from a very low interest rate environment to a average or higher interest rate environment, there's been a lot of market turmoil. So recently, the CEO of Goldman Sachs mentioned that there's a good chance of recession and it's time to be cautious. I think I've told you previously, Jamie Dimon of JP Morgan has talked about a financial hurricane. What he's most recently talked about is that with the failure of FTX, that investors in crypto is like investors' pet rocks. And so now another thing that we have coming up this week is the former founder and leader of FTX is testifying before the House this week, Sam Bankman-Fried. It'll be interesting to follow what he has to say. It seems like every week there's an onion of, as you peel away an onion, there's more and more things that we're learning about FTX and how that worked. But on a kind of a more traditional note, things that we're talk about more frequently is the housing market, and how's that performing, and how do people feel about that? So I did a quick Bloomberg search before posting this MMU, and on September 20th there was an article, "The housing market bending, not breaking on rates." Then on September 23rd, "Housing market not as bad as it seems." Then on September 28th, "Housing market FOMO replaced by fear of buying at the top." That's only an 8-day window. So no postings came up for October, but November 3rd, "Housing market gloom threatens to put sawmills on the chopping block." So that headline really resonates, because if you go back about a little more than a year, lumber prices were very high, and there were lines at Home Depot on days that lumber was delivered because it's so hard to get. And now there's an article saying that with the housing market where it's at, that now there's been such a slowdown in lumber that these companies that make it are at risk. That all happened very quickly. And so it'll be interesting as the FOMC takes their action this week, kind of what that has in store for us. But one thing I can say is things have moved very quickly with the dramatic increases that we've seen here. And here you can see, as the Fed has made moves, kind of how our interest rate environment, or the Treasury interest rate environment, has changed. The green line represents a standard yield curve. Starts off in the earlier years with lower rates, and you work your way up as you go out longer. Relatively flat yield curve. Oftentimes investors require more yield for time. But then the red line, what that represents is an inverted yield curve as of 12/9/2022. And what you hopefully are noticing there is the shorter term rates have higher interest rates than the longer term rates. And that's an inverted yield curve. And to get more granular with the areas that we focus on, you have the MMD, the 30-year MMD here, and how it's changed on a monthly basis. The very first week of the year, we start off with 1.5. So investors would loan money for the AAA credit for 1.5%. That went as high as 4.06 at the very beginning of November, and now it's come back to 3.48. And so then if you look to that far right column, you can see some pretty dramatic changes. But first of all, between the end of January and end of February, no changes. It was flat. Certainly had some changes in between there, but where we ended, it was flat. But so far, November was a very good month for us. And so far in December, we're actually 2 basis points lower than that. The 30-year MMD is at 3.46 versus at 3.48 from our data point there. So seeing a bit lower interest rate movements in the last month. I think a lot of industry participants believe that some of the comments made by the Fed chair that seem to indicate that we might not need to continue to have 75 basis points indefinitely. Certainly could be a contributing factor towards the decline in rates versus the steady increase we've seen in many other months. What we show here is that MMD we show for every maturity, years 1 through 30. Then the bar charts, what those show, the gray bar charts, what they show is the range of interest rates going back to 2005. The red line represents the MMD as of 12/8/2022. What I see in this chart from looking at it frequently is the red line in years 1 through 10 has drifted more towards the middle. It was a little slightly elevated over the last several postings. And then that looks more consistent with the longer term, which is right around or just slightly below the average point. So while it feels like rates are much higher, when you compare it to a historical perspective, they still are relatively average. Now we continue to see some outflows into funds on a weekly basis. This could go one way or another. They do appear to have declined to some degree, but hopefully as investors see higher yields and less, maybe less there, as investors see higher yields and as there's more concern about a recession, whether it's CEOs talking about it, whether it's an FTX failing, those types of things, if investors' risk profile shifts, you may see more investors interested in municipal bonds. I'm not saying the FTX investor will immediately jump into municipal bonds, but as everybody shifts down that risk profile, we may see inflows into municipal bond funds, which will create more demand and then put pressure on rates downward. Now, we do have a real limited amount of supply. So even if we don't have as many investors, we also don't have as many bonds. Those dotted lines, what they represent are weekly averages for the last 3 years. Hopefully what you're noticing is that shaded for a bar chart for for December 12th of 2022, that's much lower than those averages. And so while there might not be as much demand, we also don't have as much supply. Hopefully that's a sign or a indication that rates can be lower. Here are some economic data points that will be released in the next 2 weeks. But really, I think inflation, anything related to inflation and FOMC indication or action are the most important things to focus on. On this last slide, you have the Fieldman, Rolapp Associates registered municipal advisors. I encourage you to reach out to any one of them for additional information on the municipal market. I thank you for your time. We look forward to talking to many of you in 2023.